Hey everyone, and welcome. Today, we're diving in and building a real playbook, one based on the core ideas of legendary investors like Warren Buffett. Our goal here is pretty simple: to demystify value investing and turn all that complex theory into a clear, actionable strategy that you can actually use.
Okay, let's kick things off with this quote from Morgan Housel, because it just gets right to the heart of everything. It tells us that the very first stock we need to analyze isn't out there on the market, it's us, right? Real, lasting success in investing, it isn't really found in some complicated spreadsheet. It's found in mastering our own behavior.
I mean, we've all heard it a million times. Buy low, sell high. But let's be honest, that advice is completely useless without a framework to actually define what low and high even mean. So today, that's what we're going to do. We're going to build that framework and turn a tired cliché into a powerful, working strategy.
And that whole strategy? It starts with the single most important concept in all of investing. I mean it. This is the one idea that separates disciplined, long-term investors from just hopeful speculators. This right here is the fundamental shift in mindset. When you buy a stock, you're not just buying a ticker symbol that you hope goes up. No, you are buying a small piece of a real, living, breathing business. And that simple change in perspective forces you to ask totally different questions. Questions about the company's actual health, not just its daily price swing. And to help us remember this, Benjamin Graham gave us this brilliant character, Mr. Market. Just imagine he's your business partner, but he's completely manic. Some days, he is absolutely euphoric and offers you ridiculous prices for your shares. Other days, he's terrified and will practically give you his shares for pennies on the dollar. Your job is to completely ignore his drama and just use his irrationality to your advantage.
So if Mr. Market's price is totally unreliable, how in the world do we figure out what a business is actually worth? Well, to find that intrinsic value, we're going to need the right set of tools.
Forget all those intimidating, complex formulas for a second. Warren Buffett boils it all down to these three simple, powerful questions. Because at the end of the day, a business is only worth the cash it can spit out for its owners over its entire lifetime. That's it. Our job is just to make a reasonable estimate of what that future cash looks like.
And this brings us to maybe the most important tool in the entire kit. Because let's be real, our answers to those three questions, they're never, ever going to be perfect. The future is just too uncertain. So the margin of safety, that's our defense against that uncertainty. It's the cushion, the discount we demand between our estimate of a business's value and the price we're willing to pay for.
And this is the key. Having a margin of safety isn't about being cheap, it's about being humble. It's a built-in admission, right up front, that, hey, we could be wrong about this. Insisting on that discount is what protects our money from our own mistakes, from just plain bad luck, and from a future that none of us can possibly predict.
Okay, so we got the mindset down and we have the tools. Now let's talk strategy. And it all begins by recognizing this incredible advantage that most individual investors don't even know they have.
It sounds like a trick question, doesn't it? I mean, how could anyone possibly beat the greatest investor of all time at his own game? But as investor Joel Greenblatt points out, there's actually a surprisingly logical answer.
You don't play his game. See, Buffett manages so much money that he has to fish for whales. These giant multi-billion-dollar companies. He has to. It forces him to completely ignore this vast ocean of smaller, nimbler companies. And that, right there, that is your fishing ground. You can go out and hunt for incredible bargains in places he can't even look.
And you know what? The data backs this up beautifully. Joel Greenblatt showed that a pretty simple strategy of just buying cheaper, smaller companies dramatically outperformed the S&P 500 over a long period. Now think about why that is. A standard index like the S&P 500 is market cap weighted, which is just a fancy way of saying it automatically owns more of the biggest, most expensive companies. A value strategy does the exact opposite. It systematically hunts for the bargains.
Which brings us to what is, by far, the hardest part of this whole thing. Look, we can have the best strategy in the world, the best tools, but they're absolutely useless if we can't control our own minds. The biggest opponent you'll ever face isn't the market. It's the person staring back at you in the mirror.
Morgan Housel has this incredible way of reframing market crashes. He says volatility isn't a fine you pay for doing something wrong. No, it's the price of admission. That gut-wrenching, sick-to-your-stomach feeling you get during these moments, that's the fee. That's the price you have to be willing to pay to earn the amazing long-term returns the market can offer.
This story is just the ultimate proof of that idea. Ronald Reed, a janitor,
didn't have some fancy finance degree, but he had something way more powerful: patience and discipline. He wasn't trying to keep up with the Joneses, and that really highlights another internal threat that's just as dangerous as panic: envy. The goal isn't to beat your neighbor, it's to secure your own financial freedom.
So, how do we win this mental battle? Well, we do what Odysseus did when he was sailing past the sirens. We tie ourselves to the mast. We create a simple, logical plan before the storm hits while we're still thinking clearly, and we commit to it. This kind of mechanical process is what prevents us from making those catastrophic emotional decisions when panic is in the air.
All right, we've talked about the right mindset, the right tools, and the right discipline. But there is one final piece to this puzzle, and it's one that trips up so many investors. When is the right time to actually sell?
First things first, we have to throw our emotional baggage completely overboard. The stock doesn't care what you paid for it. Your purchase price is a historical fact, and it has absolutely zero bearing on the company's future, so it should have zero bearing on your decision to sell. Period.
And this means all of these super common reasons for selling are just fundamentally flawed. Every single one of them is a reaction to price movements, a reaction to Mr. Market's moods, not a reaction to any change in the underlying business. This is just speculating. It's not investing.
The only valid reasons to sell are rooted in the business itself. The first is pure opportunity cost. You found a truly great idea, so you sell a good idea to fund it. And the second is when your original reason for buying the business is just no longer true, when the company's competitive edge has faded or its future just looks permanently dimmer.
And so we end right back where we started. This is the one question that should guide your entire journey as an investor. If you can honestly say you're focused on the business's value and you're not just listening to the crazy ramblings of Mr. Market, then you are well on your way to becoming a truly intelligent investor.